G'day, thanks for the comment. Looking a bit like a cowboy today. I'm out in the garden working on the food forest. So you're working hard, you're not sure what to do with the savings. There's a couple of things that you can do. If you jump in my bio and register for the Wealth Health Check link, you get access to my 2 best-selling books, but the first one's really going to help you. It's a crash course on financial planning and working towards financial freedom, so it'll teach you the fundamentals. Now, in my opinion, there are basically 3 ways to build long-term wealth in this world. There is business, there is property, and there is shares. I don't have any bias towards any of them. Each of them have pros and cons. So you need to understand what the pros and cons are in the context of your situation, and then try and accumulate as much of all 3 of them in the appropriate circumstances. So let me give you a little bit of insight. Now, business is fantastic because it produces active income and it allows you to manufacture wealth through building a saleable asset that you have more control over than other assets. Because property, sure, you can do a renovation and you can do some things to manufacture wealth, but not to the degree of a business. However, a business requires you in order to invest a lot of time, and it is quite risky. The failure statistics kind of speak for themselves. So the idea is if you are in business, you need to turn your business profit, or if you're an employee, you need to take your surplus and you need to turn that into personal wealth through the other remaining growth assets, which is property. We should be buying good quality blue chip property. And the reason for that is because we can leverage and magnify our results. So if we have a 10% deposit, and let's say, for example, we go and buy, so we have 100 grand, we go and buy $1 million property, that $1 million property goes up by 5%. That is a 50% cash on cash return. We can't really get that anywhere else. So it does magnify our results. And although property and shares have returned about the same throughout history, because of that leverage, and also the fact that property typically isn't as volatile as the share market, it has a lot of pros. But the cons are, obviously, you've got to save the deposit in the first place, and you need to be able to borrow the money from the bank. So the last con is that it's illiquid. You can't sell a kitchen sink if you need to raise money. So then the third one is shares. We don't typically want to stock pick, but the benefits of shares is that we have the ability to drip feed money into the market. You can buy 1 share or 1 unit in a managed fund at a time. Typically there's a minimum investment, but let's say for micro investing apps, it might be $1. For some other apps, it might be $500. It's a relatively small amount of money in comparison to business and property. The benefit is that we can drip feed that money, which is called dollar cost averaging, so we can smooth out our returns over time. We know the share market is volatile. However, if we drip feed that money in every single week, fortnight, month, it's going to smooth out because it's going to average the buy-in as the market goes up and down over time. The other part is that it's liquid. You can sell down parts as and when you need it. And it's also a great way for you to build what I call money muscle memory of getting money into the market and proving that you can take that surplus that you've got, that savings, and you can turn it into wealth and ultimately stick it through the volatility that may exist in those time frames. Now, as I mentioned, I don't believe in stock picking. So the idea here is that we want to use an index fund or an ETF, an exchange traded fund. There's plenty out there. There's Vanguard, there's BlackRock, there's lots of other providers. I personally use Vanguard. And what you can do is you can set up a pre-mixed portfolio that aligns with your risk profile. Forgive my rooster, Woody. And you can drip feed money into the market over time. So these are the fundamentals of wealth creation. The precursor to all of this is these things are investment vehicles. You need to get clear on your destination. What are you trying to achieve? Are you working towards buying your home? Is it about funding a holiday? Is it about other lifestyle goals? Is it about having passive income so you can not work? You get clear on this, and then you can reverse engineer this backwards to help you work out how you use business, property, and shares in order to create financial freedom. I hope this helps. I'm getting back in the garden. I'll catch you soon.